Well, hello, everyone. Thank you so much for joining us today. Myself and Dan, we're going to be trying to answer your question, should I buy a home now? And if you're like me, you attend many webinars, check out lots of videos, and more often than not, you feel like you've wasted a lot of time because they take forever to actually answer your question. So I'm just going to jump right in and go with yes, no, maybe so. And I should warn you guys, this is being filmed live. So be prepared for technical issues and crazy things happening. Because right now I can't even get to my second slide. Are y'all seeing that? Yes, no, maybe so, Dan?
I have not seen slides yet.
There we go. So right there, that should be the answer to the question. And I know that's not helpful at all. So I can't tell you if you should buy a house or not. All I can do is provide you answers to specific questions. So Dan and I are going to look at some of these questions because maybe you don't think you should buy a house now because the prices are too high. Home prices are definitely up. Maybe you think the interest rates are too high, certainly higher now than they were a few months ago. I can't find the home I want. You're right. We do have low inventory. Maybe you have little to no down payment and don't know if that means you shouldn't buy or not. Or maybe you're looking at your credit score going, definitely should wait until it's higher. Yes, no, maybe so. We're going to consider that today too. So who am I? I am Miranda Moore. I'm with eXp Realty. This is a worldwide company. So even though I'm based here in Albuquerque, New Mexico, we do have agents and brokers all over that I can help you get in contact with if you're looking to buy in a different area. I'm a Homes for Heroes real estate agent, so I like to give back to my community. And as you can see on the screen, there's my contact info. So if there's anything you need after this call, you can certainly reach out to me. Dan, do you want to go ahead and let them know about you, please?
Sure, I'd be happy to. I don't see slides, Miranda, unless that's just on my end. Just wanted to let you know. So yeah, Dan Gutierrez. I am a mortgage lender the last 25 years with a prior background as a financial services rep with Bank of America. So my company, CMG Home Loans, is the fourth largest company in the country. We lent a considerable amount of loans and business in the last several years to where we were able to build a servicing portfolio in excess of $100 billion. So we're doing really well as a company, very healthy. And that's worth mentioning because it reflects in what a company is able to do in terms of their offering, term times, having enough staff, across the nation to meet the needs of, originators and close on time. It's very important. Departments that phase, from processing to underwriting to, the closing docs. It's huge. So we've got a really great mousetrap, and we've acquired one company in the last this year, propelled us into the fourth largest mortgage lender, in the country. So we've got a great deal right now. We are offering a free 1-point temporary buy down for all of our new buyers. So Miranda, as you and I work with, our buyers together, the loan that they get will have, the market rate as their note rate. But for the first year, CMG is going to prepay their interest to meet the difference between their their note rate and a 1% reduced interest rate payment for the first year. So that's what they get. It's predicated on a 1% lower interest rate. It is a temporary rate buy down. CMG is doing this for every borrower, and we can afford to do it. And we're servicing our clients. So I've been the former president of the Mortgage Bankers Association here in New Mexico, and I've really dug deep into assisting my community. My industry is just really important to me. Been an industry partner for a long time, and I try to stay at the forefront of what's going on. With big issues like mortgage rates, like increasing home values. Like millennials come in, with the largest buying block. Even outpacing what we saw in the baby boomers generation. But here to serve and here to write mortgage loans. So thanks, Miranda. Thanks for having me here with you today.
Oh, sure. Thanks for joining me. Can you see the slides now?
Yes, looks great.
Awesome. Okay. Because this slide is definitely important. This is the home price forecast for 23 and 24. So something I've obviously heard from a lot of my buyers, especially those that were looking this summer, is, I'm going to wait because prices are too high. And that is completely and totally understandable. A high price does mean a higher monthly payment, potentially more money down that you need. But here's the deal. They're showing that, yes, prices have gone up, but it looks like they are going to continue to go up. So this right here is from Keeping Current Matters, and I put the website there. So this is not my data. This is their data. They looked at what these other places were saying, what those expectations were, and are giving us their expectations. I know everybody is hoping for a home crash like we had in 2008, 2009. And there's just been so many things put in place. And Dan, I know you can attest to that. It's just unlikely, just absolutely unlikely. Are they going to, jump up as much from 23, 24 as they did from 21, 23? No, we're not looking at a sharp increase like that. But the fact of the matter is inventory is low. We've had inflation. As a general rule, home prices go up. And so that's just what's expected to continue to happen.
Agreed. I couldn't agree with you more.
And then obviously along with the home price, the other thing that has people freaking out is that the interest rates are too high. And I put that in air quotes because, Dan, you've seen the numbers. Once upon a time, people were buying homes with double-digit interest, and we're certainly not there, but we're higher than 2 or 3. So I'm going to stop sharing my screen so you can put up your information there.
Great. That sounds good. I am looking for that arrow that usually, there it is, found it.
The joys of life. Things just never work out the way they're supposed to.
I know it. But they are going in the right direction here. For a nice screen share. All right. Well, you addressed, some really, really super hot topics, and really that's what is, leading the day is, this change that we've had in, mortgage rates. It seems like, we have these high interest rates, and then we have, I'm just kind of moving around, get the right slide here. In mortgage rates, they just go up and then they go down, and, what governs all of that? Why is it? Why do we have that, in our economy? Can you see my whole entire slide right now?
Yes.
Okay, good. So I wanted to kind of just get down to what is fundamentally at hand, and that is economics. Economics are repetitive, they're cyclical, and mortgage rates are the same because they are a technical item that is injected within our economy that is dynamic and fluctuates with the rest of the ebb and flow of what goes on in our market dynamics, economy, i.e. So if we take a look at this chart, it kind of illustrates everything. I'll break it down for us. What I'm trying to illustrate is that we have cycles in this economy, and we are merely in a cycle. So when we panic about interest rates, the fear is not knowing, why that is, and the where, the when, and the how. Essentially, what has gone on in the economy is that we experienced a extreme phase of growth. That's in a expansion phase. We finished that expansion phase, and then we hit the tail end of that, which would be a peak phase in our economy. That's when the economy super overheats, gets to a point where the Fed steps in, because we've got inflation this last go around, which was pushing 9%. The Fed comes in and begins to close the money supply down and initiates quantitative tightening. That's closing down the money supply, slowing down growth because it's a little out of control. Prices are out of control. We have inflation, and we've got jobs that are threatened. So the dual mandate for the Federal Reserve is to govern both employment throughout the long run, and then also to control prices, which essentially is inflation. So what's going on here is that the Fed is merely in a cycle where we are just about to begin contracting, where we will then see a lowering of the federal funds rate from the Federal Reserve. That will affect all other consumer interest rates across the board very quickly. So we know that the Fed is going to begin doing this because in the October numbers for GDP and both jobs, we saw that both are cooling. And that's been the question as to whether the Fed would continue with its quantitative tightening with increasing the interest rates, slowing down the money supply, was that the Fed wanted to see and needs to see GDP and jobs go down, within a couple of months for sure, with a good trend, knowing that they've done enough, to slow the economy down. So the phase that we're in now, as we step into contraction, the Fed will begin to increase the federal funds rate. And when they, decrease the federal funds rate, got to make sure I get that right. He's going to be real technical there. So rates drop, mortgage rates drop, and we go into a little bit of a recession because, employment's going to be out of whack. And, that's the entire reason why the Fed is opening the money supply up because, it seems like they always overcorrect and under, correct, whatever. They always go too far or they never do enough. Usually they go too far because they want to be, in fairness to them, they want to make sure that they don't have to go back in kind of thing. It's like, doing surgery, we're just going to take it all out the first time. We don't want to go back in. So they don't want to come back in and say, well, we need to tighten more. Jerome Powell, the Fed chief, does not want that on his shoulders. I mean, no Fed chief has had to do that before that I'm aware of in the last 30 years. And, he doesn't want to be the guy that, screwed it up and, didn't go far enough. So just one more note on this slide to kind of tie it in. That red bar or that green, graph is indicating the federal funds rate. That's where the Fed is, showing, where it increases it or it has it increased. If you take a look at the cycle from 96 to 2000, it's a little level, but there's an increase from 2000 to 2002. It goes from 5 to 6.5. The Fed manipulated the federal funds rate there. And we saw a recession that came in sometime in 2001, essentially. So the Fed drops the federal funds rate. That green line graph is going down. Federal funds rate goes down to 1% in 2004. And then we see that, the Fed did its job and probably overcorrected. And now we've got inflation. So, and employment is being threatened. So what does the Fed do next? In 2004, the Fed begins increasing the federal funds rate, gets it all the way to 5.25. I think it may be even like, probably 5 and, oh my gosh. Probably 5.25 as high as it went, I think. So it kind of plateaus. And then guess what happens? Throws our country into recession again. You see that gray graph bar that's going up? That's the recession in 2008, 2009. Everybody remembers that. We went through that with the mortgage meltdown, the Great Recession. That was a really challenging time. So what does the Fed do? The Fed drops that federal funds rate in 2008 and drops it all the way down to 0.25%. Really low, extremely low. And all the other rates follow. So from 2010, after the mortgage meltdown to about 2016, we enjoyed really low interest rates. The economy grew, but then inflation crept in 2016, and you see the cycle repeat over and over. So what we're in now is that same sort of repetitive cycle. And we know that with GDP going, down and jobs also cooling, we know that the Fed will begin quantitative easing soon, and they'll begin dropping the federal funds rate, just like we see on the green graph as it goes all the way, down to nearly zero. Mortgage rates enjoy that. All consumer rates enjoy that because the Federal Reserve is opening up the money supply, opening up trade so that we can grow and expand. But we'll shut it down again when we, see inflation get out of control, and they'll close it down by just increasing or decreasing the rates at which consumers borrow. So it's really an interesting cycle. The rest of the world follows our cycle. When America sneezes, the rest of the world catches a cold. We've heard that. So that's exactly why interest rates have been high, and they're not as high as they were in the 1980s, double digits, and mortgage rates like the news right now, seeing that the economy is, I guess, cooling. It seems like a weird dynamic, but mortgage rates, mortgage bonds, hate inflation. That's their arch enemy because it erodes long-term values of debt instruments like mortgage-backed securities and collateralized mortgage obligations. So look for interest rates to come down as the Fed begins to decrease the federal funds rate as early as, I'm thinking, February. They'll begin decreasing the federal funds rate. In December, they won't increase. They'll pause, and they'll be really happy to do it. And I'm sure, that we're going to see Jerome Powell's face lighten up. It'll look like he's had Botox, but I don't think he's going to be quite as stressed coming into this meeting, Miranda, because he knows that the economy is it's going in the right direction, and he's got to sweat bullets every night. Can you imagine having all of consumer interest rates on your shoulders, and manipulating, changing, altering / governing the world economy essentially is on your shoulders, and you go to bed every night?
Yeah, no, I would not. I'd be too stressed.
So that's kind of the take on rates. So I didn't go too long there, but in a nutshell, that's economics 101 right there.
Right, ebb and flow. Well, and you touched on a couple of things, and even in your introduction, you had touched on a couple of things, and I've heard you use the phrase, marry the house, date the rate.
Right.
And it's semi-cliche, but I mean, honestly, that's what it is. If this is a house that you really, really want, now we've got to find a way to pay for it, and that's dating the rate. And you had talked about your company is doing a buy down, and you had talked about it's a temporary buy down, which obviously implies there are permanent buy downs.
Right.
And then obviously we've all heard the word refinance, but for a minute, talk about how exactly a buy down works. And I know you've mentioned like 2 or 3 different kinds.
Yeah, I'd be happy to. Essentially, there are 2 types of mortgage interest rate buy downs: permanent and temporary. First, the temporary. The temporary buy downs are defined as products such as 1-0 buy down, 2-0 buy down, 3-2-1 buy down, 2-1 buy down. Now, what these are essentially is the someone is paying for the spread, the margin between the actual note rate and the temporary rate, which would be the buy down. So whatever that buy down is, say it's a full 1%, so 1-0 buy down, then there is a deficit between what the note rate is and what the actual bought down rate is for the say the first year in a 1-0 context. So that interest, that spread, has got to be paid by someone so that the CBO is whole and the investors are whole, and there are no gaps with in the investment accounting. So basically, CMG Mortgage, my company, is paying the difference in interest between the actual note rate and that lower 1% rate the first year we're giving to all of our borrowers. So all of our borrowers get a 1-0 free buy down. That means they're if the rate is 8.25%, their note rate for the first year, their interest rate and their payment is based on a rate of 7.25%. So 1% less, and it really makes a huge difference. So CMG is paying for that, and it's partly because we can afford to. I don't see any other companies doing that right now. So that's the 1-0 buy down. That's what we're doing free. Now, temporary buy downs basically pay the difference of interest for a duration. So if you do for example, a 3-2-1 buy down, note rate's 8.25%, your first year rate's going to be 5.25%. So 5.25%, first year 6.25%, then 7.25%. Then on the fourth year it goes to the note rate. So the reason that buy downs, temporary and permanent buy downs, are important in this market as it is a strategy to purchase property is because it drops the monthly payment and it serves as a stepping stone. If a person goes in with a below market interest rate of 4%, below 4%, less than the current interest rate, market interest rate, they're at an advantage. Yeah, someone paid for that, and sellers can do that by paying for these points, these buy down points, as opposed to paying for price reductions. It's much more competitive and lucrative for a buyer to receive buy down funds from a seller. Very lucrative. That's what we're teaching. That's what we're preaching. So these buy downs effectively allow buyers to get into the market, purchase property, because we know that property increases in value, and it doesn't stop. Historically, I don't have a slide up now, showing that, but property valuations have increased. We always said, property, appreciation. We saw some weird markets like the 2008, 2009 market. That was a different thing. That there was a bubble with housing there. It was fictitious, the values. But we haven't encountered that in this market. That's not what we see at all in this market. It's real and it's holding. So we know that we can definitely get a lower interest rate. So it's a stepping stone to purchase property. Because, here's the thing, Miranda, is if a person waits a year for interest rates to come down 1%, and in that year, that property, say at an average median home sale price of 360, has appreciated 8% during this year this consumer is waiting. So we run the math. They now have a 1% lower interest rate, but the property appreciated 8%. We run the payment, and we find out that they've only saved $18 by doing that. $18. So it doesn't pay, yet the property appreciated, $22,000. That equity on a consumer's balance sheet is, where they want it. They want it on their balance sheet as a credit, and not on, the seller. The sooner they become a buyer and own that property, that becomes their investment. They've made the money. So it's obvious that, home consumers need to purchase a home. They want to buy a home. They're going to have a housing payment, whether they rent or do whatever. So why not own your own home? They feel it's challenging in this market because of interest rates, but with the right structure, a home can be purchased and effectively. And we've got all the answers here. There's no reason that this market should slow people down, because we have fixes for all of this. We have a fix going in with a temporary buy down and a permanent buy down. We've got CMG's free 1-point buy down to add to all of that. We've got my rate rebound program, where I'll refinance anyone that closes a loan with me for free when mortgage rates drop, and they won't have any mortgage lending costs, and we'll give $1,000 at closing towards third-party closing fees. So I guess what I'm saying to kind of wrap up this point, Miranda, is there's no reason for anyone to avoid buying right now because rates are too high, or waiting for rates, are waiting for housing prices to come down, or for more inventory to suddenly appear on the market, which it will eventually here. But there's no reason to wait, because you can buy now, or you can wait for all these things to happen, and you can buy when everybody else is buying. I mean, it will literally be a frenzy. And the last point on that is, we're seeing licenses in mortgage lending, and also for real estate agents. We're seeing that many participants in these professions are not renewing their licenses in 2024, in December of 23 for the 24 year. It's because things have been a little bit wacky and tough in real estate and lending. But I assure you, the purchase volume we'll see in 24 and 25 will be the largest we've seen in our lifetimes. So my advice is to stay with it, for one, but also don't get in there and be in the huge frenzy where everyone's buying at the same time. I mean, you could have a lot of attention right now, classroom size of 9, or you can be classroom size of 100. Seriously, that's the disadvantage if you wait. One of them. There are many. So okay, so back to you, Miranda. Thank you.
So while we switch sharing screen, so I'll have you unshare so I can share mine. And there go my dogs. One thing you kind of touched on was the buy downs. And so just to be clear, if I do a 3-2-1 buy down right now with the 8% rate, and we buy it down, and then in January it drops to 5, even though we did the 3-2-1 buy down, can I still refinance? And did I lose anything by buying the 3-2-1 buy down and refinancing?
Excellent question. The answer is, short answer is that no, you don't lose anything. You get back any unused portion of what the cost was on that buy down. It's got to go to someone. It's going to go to the consumer, and that's the law. So we're bound by federal regulation to ensure that the consumer gets any residual buy down costs that were associated with their loan, whether they paid it or the seller paid it. Good stuff there. So that's the thing on whether or not they've lost their funds or not, or if they just throw that money away. But we'll refinance them when that comes, and at that point they'll get a great market rate, and they won't pay for an appraisal cost, they won't pay for a lender fee, they won't have to deal with the tax service. We'll cover all of that. And we'll also give them $1,000 towards third-party closing fees. So you're covered. This is the mousetrap. That's how we get out of the maze. It is it has been done. We've already got people that are already purchased with our 1.0 buy down, free. And we've got other sellers and buyers that are offering and paying for and participating in, temp and permanent buy downs. So we've got the solution. There's no reason that anyone should wait. No reason at all. Let that equity be yours.
So then, can you see my slide?
Yes.
Okay. So yes, inventory is low. And so something you might say is, I can't find the home I want. How hard have you looked? One thing we always tell people, I mean, the first thing you want to do is think about your monthly payment. So that's why step one is always find the money. Get with the lender, y'all two hash it out. This is how much I can afford for my monthly payment. Like Dan said, there are, I would say, tips and tricks to get a monthly payment what you want, separate from the home price, because like you said, you can adjust the interest rate with buy downs and things like that. But then once you have that monthly payment in mind from the lender, then we can start looking at home. One of the realtors I work with, his big thing is pick the neighborhood, which is true. You definitely, have things that you want to consider, where your kids are going to school, how far you're driving to work. What is the internet like in this spot? Because I've had that issue before in places.
That's
it's
important.
So frustrating. But at the same time, if you are super hyper, like, no, I only want something in these, 3 blocks. Okay, yes, you may not have the home you want. But you can expand out what you're defining as your neighborhood. New builds right now they're building. I just got a call from a new neighborhood wanting us to go out there and check out their new builds. So new construction, if you haven't considered it before, because, oh my gosh, you're overpaying. Maybe not right now, because these builders do want to put people in their homes. One thing that we always talk about, there is no perfect house. You have your needs list and your wants list. And so, yes, for my family, it's me, my husband, a boy, and a girl. So minimum, I'm looking at wanting 3 bedrooms. That's basically a need, because I don't want to share with my kids, and I don't want my kids sharing together. That's a fight I don't want to have. So that is definitely a need and important to look at. There are 3 bedrooms out there. There are 4 bedrooms out there. So the question is not, is this your perfect house? I hope you can find that. Probably not. But does the house meet 85% of your needs and wants? There are so many things you can do to a house after you purchase it. We put in a closet literally out of thin air, pretty cheap, working with a contractor. We turned a half bath into a full bath because we wanted a shower downstairs. So the house may not be perfect right now, but as you build up equity in your home, you can get a HELOC and start making that home into 100% the perfect home. Of course, then a kid moves out and your needs completely change anyway. So it's really important to look at, why are you moving? Do you need to move for a job? Are you driving 2 hours a day to work and it's just going to save you money by living closer to where you live? If you're just wanting another house for the sake of having another house, maybe you want to wait. Maybe you want to go ahead and get that second house. But just know that there are options out there for you. And then the last part, Dan, that if you just want to touch on real quick, because I know people have, said, because the home prices are so high, I don't have down payment. So if you just want to talk real quick about down payment assistance, and then also how to increase your credit score, if there's credit score assistance, if you just want to take about 3 minutes to cover what kind of options there might be for someone like that.
Sure, you got it. Yes, Miranda, there are options for both. So, house is too expensive. We look at how we can bring the payment down, because really what that means is my payment is too big. And someone tells me, that's too much of a home, too much sales price, too high. It's really related to, what their monthly payment is. So we'll look at what we can do with their monthly payment. That's really important. Down payment assistance is flourishing. We have the gold standard, which is New Mexico Mortgage Finance Authority. Currently, we're writing, loans each month with them on a mass scale. They have a below market interest rate right now. Their FHA rate is 6.5, Miranda, fixed 30-year. And the second mortgage, which picks up their down payment, is 4% of the sales price. On an FHA loan, we only need 3.5%. FHA gives you 4%, a little second mortgage, 4% of the sales price. If you're buying a $400,000 home, that's $16,000. They'll cover your 3.5% down payment in the form of a second mortgage. And that looks better, by the way, Miranda. When we're running an automated approval, we always get an approval, much more readily if we're struggling to, achieve that with a particular loan file. If we can say that the funds for down payment are being borrowed as opposed to funds being gifted, isn't that interesting? How somehow there's a correlation between that and risk. Risk is all based on prior experience with default. So, I mean, that just is the way it is. So, you get a second mortgage, covers all of your down payment. And then, Miranda, you know how we're going to write that contract if the buyer doesn't have closing costs. How do we handle that? I mean, tell the buyers, how do we skin that cat? We get the seller to do what?
I mean, yeah, the sellers can give credits, and
Right.
the credits, rather than reducing the price, they just take less there at the end of the sale. And it can either be cash to you that you can use on repairs, or you can use it right there, not to buy down the interest rate, but to help pay for closing cost. And it's really interesting because it's considered a seller's market because the inventory is low. But right now, buyers are negotiating. They're negotiating for repairs. They're negotiating for closing costs for these interest rate buy downs. I mean, it's not the wild, wild west like it was.
Right. It seems a much more balanced, and we're approaching equilibrium. Buyers and sellers are really working together more than I've seen here in the last probably 30 to 60 days. So yeah, I'm glad you point that out. But a seller can also legally increase the sales price in a deal. It's perfectly legal. In fact, you even have a form for it. I think it's called something like seller concession with rate buy down, or with point something discount. Something, there's a form that really just, random form that really ties it up nicely. So perfectly allowed for a seller to say, hey, Mr. Buyer, you're asking me for another, $7,000. Well, you can have it. I just need to increase my sales price by $7,000. And here, we'll put it in writing. Here's the random form that we use to do that. So perfectly fine. That's a way to skin the cat. That really is just a way to skin the cat. So, we'd be surprised. We're doing MFA loans, for just FHA buyers because the rate is so low. We can get there that first year with the 1% freebie from CMG Mortgage, the 1.0 buy down. But on an FHA loan, a buyer just needs a 620. And if they don't have a 620, we'll put them in credit counseling. What does that mean? Well, we basically pull a credit report. We pay for it. We upload it to one of our vendors, one of our national vendors that works credit repair. They get to take a look at it. They have a free consultation over the phone. Actually, it's probably a some kind of a video conference of things of this sort. I haven't been on one personally, but they kind of review with that consumer. Hey, this is what we can do for you. It might look something like this. So Miss Borrower, you should be creditworthy. Dan said you need a 640. Give it 20 points. And you need it within. You probably get it to within 90 days. This is what we're going to do. We're going to pin your credit up. We're going to use all the legal provisions to do this. And voila, we got a 620 or a 640. Run them through the system. We'll give them down payment assistance up to the FHA loan limit, 345. I think it went up higher. I need to look at that. So we'll give them the FHA loan limit. Actually, I take that back. MFA has a cap on that. That's where my mind was going. It's 341, 250, I believe. MFA's cap for an FHA loan. That's a lot. That's plenty. That's a fair amount. So we'll get them down payment assistance, Miranda. We'll get them qualified. We'll get them into credit restoration if necessary to get all of that underway, and they'll come out the other end. So it's always never know. It's always a matter of time. If they're willing to invest, we are too.
Thank you so much, Dan. It's so nice to have you here and share this information. And if anybody has any questions, our contact information should be on the screen again. You can reach me at 512-577-1098. And Dan, do you want to give your number?
Yeah, sure. I can be reached on my cell phone, 505-463-5101. I can be emailed at dgutierrez@cmgfi.com.
Thank you all so much, everyone. Have a great day.
Thank you. Take care.